Near 4-year lows this morning. Let's get more from Andrew Lipow, president of Lipow Oil Associates. Andrew, thanks very much. Where can we begin here? What's jumping out for you in this current crude sell-off?
Well, good morning, Andrew. I think the top two items are pretty obvious. First, it's the tariffs, not only those imposed by the United States, but the retaliatory tariffs that we're seeing from China, Canada, and an expectation of retaliatory tariffs from the European Union that are all contributing to a sentiment that oil demand growth is going to be less than expected in 2025. In fact, we saw Goldman Sachs revise their oil demand growth to only 600,000 barrels this year. On the other hand, we had the other item is OPEC Plus's surprise announcement that they were accelerating the return of the restoration of their production cuts in May to the tune of 411,000 barrels a day. You add that to the 138,000 barrels a day that they're implementing in April, and you can see here between April and May, the increase in supply is already equal to the Goldman demand forecasts.
And I mean, oil down dramatically. I mean, people aren't going to stop driving, but say there was temporarily a 5% reduction, well, that'd be pretty big, a 5% reduction in the G7. Would that be dramatically damaging for oil prices?
Well, I think it is. You're right that the consumer is not going to stop driving, but the higher prices that they're going to see at the grocery store and the malls may get them to really cut back on some discretionary driving, whether it's vacations or decreased demand for goods and services, which translates into lower demand for diesel fuel. And in addition, if you have international trade being impacted, then of course, energy demand in countries overseas goes down, and that further exacerbates, the pressure on oil prices.
What do you think OPEC Plus's game plan is here? They must have known that it would spook the oil market with this alleged plan to hike output.
Well, the one thing that I was thinking of is that these lower oil prices and the increase in OPEC Plus production gives the Trump administration some cover to more strictly enforce sanctions on Venezuela and Iran. After all, Venezuela was exporting about 700,000 barrels a day, and Iran another 1.5 million barrels a day. So the combination of oil prices falling well over $10 a barrel with more supply coming on the market can mitigate any impact of stricter sanctions.
That's interesting. So kind of an olive branch for Trump in that sense, because he doesn't want U.S. gasoline prices going up.
Well, he certainly doesn't, and you actually saw that in the tariff announcement where crude oil, refined products, natural gas are exempt from the base tariffs and the retaliatory tariffs, especially when they fall under the USMCA, which all of them do. So that's actually good news for Canadian oil producers that they're not going to be hit with additional tariffs, or any tariffs for that matter.
It's interesting, though, just taking a slightly longer look, how U.S. gasoline consumption has been flat since 2019. It never really got back to the pre-COVID levels, as far as I know, because cars are so much more efficient. And it's a similar story in China. EVs are much bigger there. And I think Europe as well, gasoline demand hasn't grown much in recent years.
Well, certainly here in the United States, the combination of additional EV sales replacing gasoline-powered cars, as well as with a better mileage, and combined with there still is a work-from-home segment that continues, that is dampened demand since the pandemic, all contributing to really flat gasoline demand. In China, it's clear that the electric vehicle market penetration is really overpowering gasoline cars, and that is impacted on energy demand there. As a result, you're seeing the Chinese focus on petrochemicals.
And also the Chinese energy companies emphasizing natural gas as well, I believe.
Well, exactly right. And we have seen an increase in the trade between China and the U.S. on LNG, even though recently China had imposed tariffs on imported LNG. But clearly around the world, with increases in natural gas exports from the United States, as well as from Canada, with a startup on the West Coast just coming on stream, in addition to Qatari increases, you can see that the world is moving more towards LNG and a more robust trade.
Finally, give us your thoughts on Russia. President Trump has talked about clamping down on Russian oil exports, but of course the market, well, people all over the world are hoping for an end to the Ukraine war. And that would be likely, or ceasefire anyway, that would be likely to bring more Russian crude onto the world market, or at least, well, I guess they might be getting a higher price for their crude. But anyway, more Russian crude would tend to be bearish, I presume.
I think that any ceasefire between Russia and Ukraine is bearish for the market, because if sanctions are eased on Russia, it makes Russian oil easier to flow. And clearly, they've been making a good use of the shadow fleet to maintain sales to China and India and a few other countries. But the ease in which they're able to access the market would actually be negative on vessel tanker rates, and some of those savings would therefore result in lower oil prices for the consumer, but better revenue for Russia.
Andrew, thank you very much indeed.
Thanks for having me.
Andrew.